Home prices in your state may finally be coming down. But here's the part no one is warning you about. Owning that home is becoming more expensive than ever. Insurance bills are exploding. Property taxes are climbing. Utility costs are breaking household budgets. So even as prices soften, millions of Americans are discovering a brutal truth. They are getting poorer inside cheaper homes. Buyers think they're gaining leverage. Sellers think the worst is over. But underneath both sides, the math no longer works. And in several U.S. states, this imbalance isn't a slowdown. It's a structural breakdown. So, which states are quietly draining homeowners dry, even as prices fall? And why does this threaten the future of American homeownership itself? What's unfolding across the U.S. housing market is not a typical downturn. This is not 2008, and it's not a short-term correction driven by panic selling or excess subprime debt. This time, the breakdown is quieter and far more structural. For the past decade, housing demand was fueled by four powerful forces: ultra-low interest rates, rapid population growth, aggressive investor activity, and the belief that prices would always rise. During the pandemic, those forces collided all at once. Migration surged, remote work exploded, and builders rushed to meet demand. Entire regions, especially across the Sun Belt, expanded at record speed. Then the direction flipped. Interest rates reversed sharply, climbing above 6.5% and staying there. Remote work flexibility began to shrink. Migration patterns slowed or reversed, and thousands of newly built homes hit the market just as buyers stepped back. Inventory started rising, not because people wanted to sell, but because homes stopped moving. At the same time, a second and more dangerous shift was taking place beneath the surface. Ownership costs detached from home prices. Insurance premiums surged across climate-exposed states. Property taxes reset higher after years of appreciation. Utilities became more expensive as heat waves, droughts, and energy demand intensified. Maintenance costs climbed as materials and labor stayed elevated. The result is a historic contradiction. Prices are easing, but affordability is still collapsing. In previous cycles, falling prices restored balance. This time, falling prices are colliding with rising fixed costs, trapping both buyers and sellers in place. Homeowners hesitate to sell because they can't replace what they already have, and buyers hesitate to commit because monthly costs no longer align with incomes. Investors are pulling back entirely as risk overtakes return. And unlike past downturns, climate risk and insurance retreat are now active accelerants. In some markets, homes aren't just expensive. They're becoming difficult to insure, finance, or even resell. This is why the current slowdown feels frozen rather than chaotic. Transactions are stalling, listings are aging, confidence is eroding slowly, month by month. And inside that stall are 7 states where the pressure is already cracking. Before we break them down one by one, remember this. What you're about to hear isn't speculation. It's what happens when a housing system built on momentum loses it. If you want to follow 7 real case studies where the numbers look better on paper, but life gets more expensive by the month, make sure to like the video, subscribe to the channel, and turn on notifications. Because these aren't headlines, they're warnings. 1. Florida. Florida was once the brightest star of America's post-pandemic housing boom. Sunshine, low taxes, and endless migration pushed prices higher at a pace few questioned. For a while, it worked. Homes sold in days. Investors piled in. Retirees rushed south. Then the costs arrived. By 2025, Florida's median home price looks deceptively reasonable on paper. But the true crisis isn't price. It's survivability. Insurance premiums have exploded, rising several hundred% in just a few years. Many homeowners now pay $7,000 to $8,000 annually simply to keep basic coverage. Others can't find coverage at all. Property taxes reset higher after years of appreciation. Utility bills surge as extreme heat stretches air conditioning use for months at a time. Flood mitigation fees, storm repairs, and special assessments quietly drain savings. As these costs stack up, demand has started to fracture. Inventory has surged across major metros. Listings sit longer. Nearly 1 in 4 sellers has already reduced asking prices. Not because they want to, but because buyers are walking away once monthly expenses are revealed. The deeper problem is insurance retreat. When insurers leave, financing tightens. When financing tightens, buyers vanish. Entire neighborhoods become difficult to sell, even at discounted prices. For longtime residents, the pressure is relentless. Fixed incomes can't absorb rising escrow payments. Families begin choosing between selling at a loss or staying and bleeding cash. Investors who once treated Florida like a guaranteed return are quietly exiting, flooding the market with listings at the same time. Florida isn't cooling down, it's being squeezed from every direction. So what happens when a state built on growth, climate appeal, and affordability becomes one of the most expensive places in America to simply stay housed? And if Florida is already cracking under these pressures, which state follows next? 2. California. For decades, California sold the ultimate version of the American dream. Opportunity, innovation, and wealth creation, all wrapped in ocean views and global influence. Housing was expensive, but it was justified by growth. That equation no longer holds. By 2025, California's median home price sits far above what the average household can sustain. But the real breaking point isn't the purchase price. It's everything attached to it. Insurance markets are fracturing under wildfire risk. In many regions, coverage is either unaffordable or unavailable, forcing homeowners onto last resort plans with limited protection and higher costs. At the same time, property taxes, utilities, and maintenance expenses continue to climb. Extreme heat, drought, and repeated fire seasons punish aging housing stock year after year. But even owners who locked in low mortgage rates are seeing monthly costs rise sharply. As affordability collapses, behavior changes. Homes are sitting longer. Price reductions are spreading. More than a third of listings in major metros have already been marked down, yet buyers remain cautious. High borrowing costs combine with insurance uncertainty to freeze demand. The pressure is pushing people out. Population decline is no longer a theory, it's a trend. Workers are relocating to lower-cost states. Employers are following. When jobs leave, housing demand weakens further, feeding a cycle that's difficult to reverse. California's housing system was built for perpetual appreciation. It assumed rising incomes, endless demand, and stable risk. Climate volatility and cost inflation have shattered those assumptions. Now the state faces a harsh reality. Homes designed for millionaires in an economy that no longer supports them. So when a market priced for wealth loses both people and confidence, how long can it hold together? And if California, once seen as untouchable, is bending this far, which state is next to feel the strain? 3. Texas. Texas was marketed as the great escape. No state income tax, expanding job markets, housing that still felt attainable. During the pandemic surge, millions bought into that promise, driving prices up at a historic pace. For a while, Texas looked unstoppable. But by 2025, the foundation of that growth is starting to crack. Home prices across the state surged nearly 60% in just a few years, far faster than wages. When interest rates rose and migration slowed, the imbalance became impossible to ignore. Inventory began climbing sharply, especially in cities that absorbed the largest inflows. Homes are sitting longer. Price reductions are spreading. In some markets, buyers now have leverage, but few are eager to use it. The reason is cost shock. Texas may not have a state income tax, but ownership costs have surged from every other direction. Property taxes continue to reset higher. Insurance premiums have jumped sharply, particularly in storm-exposed regions. Summer utility bills are climbing as extreme heat strains the grid for months at a time. For many households, monthly housing costs now exceed what initially drew them to the state. The economic picture is also shifting. Construction activity is slowing as demand softens. Energy markets are volatile. Yet employers who once fueled nonstop hiring are growing cautious. As job certainty fades, housing demand follows. What makes Texas especially vulnerable is how much of its boom depended on momentum. Population growth was assumed to be permanent. Energy was assumed to stay cheap. Affordability was assumed to self-correct. None of those assumptions are holding. Now sellers are facing a new reality, a market with more choices, more risk, and fewer buyers willing to commit. So what happens when the state built on growth discovers that growth itself was the fragile part? And if Texas is already losing altitude, which state feels the drop next? 4. Arizona. Arizona's housing boom was built on a simple promise: sunshine, space, and relative affordability. Cities like Phoenix and its surrounding suburbs absorbed wave after wave of new residents. Retirees, remote workers, and investors chasing growth in the desert. For years, demand seemed endless. By 2025, that illusion is fading fast. Home prices surged far beyond what local incomes could support. When mortgage rates climbed, buyers stepped back almost immediately. Inventory rose sharply. Listings began to age. Price cuts spread across entire developments that once sold out before foundations were poured. But price weakness isn't the core problem. Arizona is colliding with a harsh reality of cost and climate. Summer electricity bills now rival mortgage payments as extreme heat stretches well beyond traditional seasons. Water restrictions are tightening as reservoirs shrink. Insurance premiums are climbing in response to wildfire risk and flooding events that were once considered rare. These pressures are changing behavior. Retirees who moved in for predictable expenses are rethinking their plans. Remote workers, no longer fully remote, are reassessing whether desert living makes financial sense. Investors who counted on endless inbound migration are listing properties at the same time, flooding the market with supply. New construction tells the story clearly. Projects have slowed or stalled midstream as demand weakens. Entire subdivisions sit partially completed, waiting for buyers who haven't returned. Arizona's economy leans heavily on growth itself: the construction, real estate services, and population expansion. When people stop arriving, the system loses its fuel. The most dangerous shift may be psychological. Once residents begin to associate a place with rising costs and declining livability, recovery becomes far more difficult. So what happens when a market built on sunshine starts to feel unbearable? And if Arizona's migration story is reversing, which state is next to face the consequences? 5. Nevada. Nevada's housing market has always been tied to confidence. When money flows, Las Vegas expands. When confidence breaks, the fallout is swift and unforgiving. For years, the state rode a wave of tourism recovery, investor speculation, and aggressive construction. It looked like momentum had returned for good. By 2025, that confidence is cracking again. Home sales have slowed sharply while active listings continue to climb. And entire neighborhoods in and around Las Vegas now display rows of for sale signs, many of them unchanged for months. Sellers are offering concessions and incentives, not because they want to, but because demand has evaporated. The problem isn't just price. Nevada's economy remains highly sensitive to discretionary spending. When tourism softens, service jobs disappear quickly. Tips dry up. Overtime vanishes. And homeowners who rely on variable income fall behind faster than in more diversified economies. At the same time, ownership costs are climbing. Insurance premiums have risen as wildfire exposure increases. Water restrictions are tightening across southern Nevada, pushing utility bills higher and discouraging future development. These costs eat into budgets that were already thin, and investors who once treated Las Vegas real estate like a high-stakes game are pulling out. Short-term rental demand has softened, regulatory pressure has increased, and carrying costs no longer justify the risk. As investors exit together, supply overwhelms the market. Construction is beginning to buckle under its own excess. New projects are delayed or canceled. Unsold homes sit unfinished. Developers who once couldn't build fast enough are now focused on damage control. Nevada's danger lies in its speed. When growth stalls here, it doesn't slow, it drops. So if this feels eerily familiar, the question isn't whether Nevada has seen this before. It's whether the state is prepared for how hard it could hit this time. 6. Colorado. For years, Colorado's housing market felt insulated from reality. Mountain views, outdoor lifestyles, and an influx of high-income buyers turned cities like Denver, Boulder, and Fort Collins into magnets for wealth. Prices soared and few questioned whether the climb was sustainable. By 2025, that confidence is eroding. Home prices across Colorado remain elevated, but demand has weakened sharply. Inventory is rising, especially in higher-end segments where listings now linger for months. What once sold instantly now waits, sometimes quietly, sometimes desperately. Luxury has become a liability. Many of the buyers who drove Colorado's boom were remote workers, second homeowners, or investors seeking lifestyle assets. As remote work contracts and discretionary spending tightens, those buyers are hesitating. Some are listing properties all at once, flooding the market with expensive homes that fewer people can afford or justify. The strain goes beyond pricing. Insurance costs are climbing as wildfire risk intensifies. Utility bills rise during extreme weather swings. Property taxes reset higher after years of appreciation. Even affluent households are beginning to question the cost-to-value equation. Tourism, another pillar of Colorado's economy, is showing cracks. Unpredictable snowfall, wildfire smoke, and rising travel costs are dampening visitor numbers. When tourism softens, service employment weakens, and housing demand follows. Rental markets are also shifting. Vacancies are rising as renters push back against high prices, signaling that affordability limits have been reached. When renters leave, investors lose their safety net. Yet Colorado sold a lifestyle premium, but premiums only work when buyers feel confident about the future. Now, that confidence is thinning. So when a market built on aspiration loses momentum, does it stabilize? Or does it slide under the weight of its own expectations? And if even Colorado's luxury image can't hold demand, which state faces the final breaking point? 7. Hawaii. Hawaii looks like paradise in photographs. Ocean views, year-round warmth, and a global reputation that few places can match. For decades, buyers were willing to pay almost anything to own a piece of it. By 2025, that illusion is breaking down. Hawaii's median home prices remain among the highest in the nation, while household incomes lag far behind. The gap between what homes cost and what residents earn has stretched to an unsustainable extreme. Now, for many locals, ownership isn't difficult. It's impossible. But the real pressure comes after the purchase. Insurance premiums are surging as coastal risk, flooding, and wildfire exposure intensify. Utilities cost more on the islands than almost anywhere else in the country. Building materials, maintenance, and repairs are all inflated by geographic isolation. Even modest homes now require thousands of dollars each year just to remain livable. Tourism, the backbone of Hawaii's economy, is no longer a guaranteed engine of demand. As global travel slows and costs rise, short-term rentals are sitting empty. Condominiums that once sparked bidding wars now linger on the market for months. At the same time, residents are leaving. Local families are priced out and pushed off the islands. What replaces them are absentee owners, vacant luxury properties, and communities hollowed out by cost pressure. Hawaii's housing market reveals a dangerous truth. When prices disconnect completely from local incomes, demand becomes fragile and temporary. Once confidence slips, recovery is slow, if it comes at all. Paradise only works when people can afford to live there. So when a market survives on outside money rather than local stability, what happens the moment that money hesitates? And if even Hawaii can't escape the math, what does that say about the future of housing across the country? Across these 7 states, the pattern is no longer subtle. Different locations, different industries, different climates, but the same outcome. This housing downturn isn't being driven by collapsing prices alone. It's being driven by collapsing assumptions. For years, buyers were told that prices only move in one direction, that migration would never slow, that investors would always return, that rising values could outrun any increase in taxes, insurance, or utilities. Those beliefs built an entire system on momentum. Now that momentum is gone. In Florida, insurance breaks the math. In California, cost of living and climate risk fracture demand. In Texas and Arizona, migration slows and expenses rise together. In Nevada, confidence evaporates with tourism. In Colorado, luxury demand hesitates. In Hawaii, prices detach completely from local reality. What ties them together isn't panic, it's erosion. Erosion of affordability. Erosion of confidence. Erosion of the belief that owning a home automatically builds security. This is why falling prices haven't brought buyers rushing back. Because cheaper homes still come with costs many households can't absorb. And when ownership stops making sense, markets don't crash loudly and they stall, then slide. The question now isn't whether housing will bounce back. It's whether some places can recover without reinventing how housing actually works. From insurance and infrastructure to wages and climate resilience. So, is this just another correction? Or is it the beginning of a longer reset, where some states stabilize, and others quietly become too expensive, too risky, or too fragile to sustain ownership at all? If you're seeing this unfold in your city, share your experience below. And if you want to follow the real data behind where U.S. housing is heading next, like the video, subscribe to the channel, and turn on notifications. Because this story isn't finished. It's just getting started.